Every business, regardless of its size or industry, needs to keep track of its finances, and this is where bookkeeping and accounting come into play. If you're running a business, it's easy to get caught up in managing operations, putting out fires, making sales, but at the end of the day, you need to make sure that your company is financially healthy. And the best way to do that is by paying attention to your accounting. Accounting is basically the process of recording, summarizing, and reporting on all the financial happenings of your company. It is an absolutely critical part of running a successful company so that you can make sure your company is financially healthy and making a profit. Now, there are a lot of different ways that you can look at the financial data within your company, but the most important ones are the three financial statements. Those are the income statement, the balance sheet, and the cash flow statement. Each of these reports provides different information about your business, and together they provide a complete picture of your company's financial health. So in this video, we'll go over a quick introduction of the three financial statements, what they are, and how to use them. We begin with the income statement. The income statement, also known as the statement of profit or loss, or the P&L, focuses on your company's revenues and expenses over a specific period of time. It's the financial statement that most people find most exciting because it tells you how much money you're making. An income statement can come in many different formats, but it'll generally include a few key components. At the top, you'll find your revenue. This is the money that your company makes from selling your products or services. Below that, you'll find your cost of sales or cost of goods sold. These are the direct costs associated with you being able to generate that revenue. So just for a quick example, let's say I bought some drones from a manufacturer at $100 and I sold them to a customer for $500. So then, very straightforward, my revenue would show $500 and my cost of goods sold would show $100. The next component you'll see on the income statement is your expenses. These are all the other expenses that your company incurs to exist. These are sometimes split into operating and non-operating components. So operating will typically show things like rent, advertising, salaries, while non-operating will be things like interest expense or taxes. And the last component that you'll see on your income statement is your net income. Your net income is just what's left over when you deduct all of your expenses from all of your revenue. So now that we know what a basic income statement looks like, how do we actually use it to help us make decisions? While an income statement can look pretty simple, it can also get quite complex. And if you have the expertise, there's a lot of depth that you can go into to analyze the profitability of a company beyond just looking at the net income line at the bottom. But for this video, here's a really quick summary of how you can get a little bit more comfortable around an income statement. The first thing you'll want to look at is your top line, or the revenue. Everything in your business flows from revenue, so this number is extremely important to keep an eye on. Next, you'll want to look at how much of that revenue you actually get to keep. To do that, we look at something called your gross profit. Your gross profit is simply your revenue less your cost of goods sold. So going back to the earlier example, if I sold drones for $500 and it cost me $100, my gross profit would be $400. This is an important number to keep an eye on because it is reasonable to assume that if I doubled my sales from 500 to 1,000, I would also double my cost of goods sold from 100 to 200, and that means that my gross profit would go from 400 to 800. This gross profit number has to be high enough to cover all the other expenses that exist in the business. And if it's not, I won't be able to make a profit. Next, you'll want to look at all the other expenses in your business beneath the gross profit. This will tell you where all the money in your business is being spent. And then you'll want to look at your bottom line, which is your net income or loss. So when we say, let's look at the bottom line, this is what we're referring to. Now, it's easy enough to just read these numbers, but how do we actually interpret it to be able to make some decisions? Well, there are two main ways that you can do this. The first is to look at performance over time. So if I were to look at the income statement of each month for the last 12 months and put them side by side, I'd be able to notice if there are any trends developing. This can be used to identify positive trends like revenue going up over time, or even some things that might be concerning like my software costs going up higher than I expected. Another way to look at this information is by looking at each line of your income statement as a percentage of revenue. You'll have to have some industry knowledge here to be able to understand what makes sense or doesn't. So if you're running a service business, then maybe payroll being 30% of your revenue makes sense, but if you're running an e-commerce brand, then that might be a little bit too high. So performing analyses like these will help you identify how your company is doing and maybe even find areas where you'll be able to make some improvements. So this was a pretty quick overview, but if you'd like to learn about the income statement in a little bit more depth, you can check out the video for that in the corner or in the description box below. The next financial statement to look at is the balance sheet. The balance sheet provides a snapshot of your company's assets, liabilities, and equity at a specific point in time. The balance sheet's layout is based on something we call the basic accounting equation, which is that your assets are equal to your liabilities plus your equity. What that basically means is that what a company has must equal what it owes to third parties and what it owes to the owners of the company. We do have a video that goes over the basics of accounting, including the accounting equation, which I highly recommend you watch, so you can find the link for that in the description box below or in the corner somewhere. somewhere. So given that it's based on the accounting equation, the balance sheet will look a little something like this. At the top, you'll have your assets. These are all the things that your company owns that has value. These will typically appear in two subcategories, current and non-current assets. Current refers to anything that'll materialize into cash within the next 12 months. So that's usually things like cash itself, inventory, or accounts receivable. Non-current are the assets that you'll typically hold long-term, so things like land or machinery. Beneath the assets, you'll find your liabilities. These are things that you owe to other parties. The liabilities are also divided into current and non-current, and the same premise applies. Current liabilities are those that need to be paid within the next 12 months, so that's your credit card bills, your accounts payable, or the current portion of any outstanding loans. And the non-current liabilities are those that you won't be paying for more than a year. And at the bottom of the balance sheet, you'll find your equity section. This generally represents your remaining value if you were to sell off all of your assets and pay off all of your liabilities. So in essence, this is the value that's left over for the owners of the company. Usually in the equity section, you'll find all the money that was invested into the company by the owners, as well as all of the profit that was accumulated over time. So if that's what a balance sheet looks like, how do we actually use it? The complexity of a balance sheet can vary a lot based on the type of business you're running, but here are a few quick tips of how to use the information that you find. You'll want to look at the various asset accounts and make sure that they're at an appropriate level for what your business does. For example, seeing a high cash balance, generally a good thing, but seeing a very high accounts receivable balance might mean that you're not collecting on your invoices. If your inventory balance is too low, that could be a bad thing because you might go out of stock soon and then might miss out on some potential revenue. On the flip side, if your inventory balance is too high, that might mean that you have some slow-moving inventory and too much cash is tied up in inventory. Knowing what those right numbers are requires you to know your business well, but it can be helpful to look at the balances over time to identify any massive fluctuations. You'll want to perform a similar analysis for your liabilities. If any of the balances are too high, that might mean you'll experience a cash crunch soon. A really useful way to analyze your balance sheet is by using ratios. For example, comparing your current assets to your current liabilities gives you an idea of whether or not you have enough cash and potential cash to cover the liabilities that will be coming due within the next 12 months. If your current liabilities are much higher than your current assets, that means you're going to have to generate a lot more cash really quickly. The balance sheet can be a challenging financial statement to review, but its importance realistically depends on the type of industry you're in. If you run an agency, all you really care about is your cash, your accounts receivable, and your credit card balances. But say you're a manufacturer and you have land, machinery, and debt, then it can get a lot more complicated. If you'd like to learn a little bit more about the balance sheet in depth, you can check out the video in the description box below or in the corner. And the last one to cover is the cash flow statement. This statement tells you all about your company's cash inflows and outflows over a specific period of time. The cash flow statement is extremely important because it tells you about the most important thing in your business, which is cash. Keep in mind though, this only matters if you're using the accrual basis of accounting. If you're using the cash basis of accounting, it's basically identical to your income statement. If you'd like to learn the difference between the cash and accrual basis of accounting, there's a pretty simple video about it in the description box below or in the corner. The cash flow statement will typically be laid out in three main sections. Cash flow from operating activities cover the day-to-day activities that generate your main revenues and expenses. So that's stuff like the cash that you collect from your customers and the cash that you spend to pay off your credit card bill. Cash flow from investing activities covers the cash that's involved in the purchase or sale of long-term assets. So that can cover stuff like the cash that you receive if you sell a machine or cash that you may lend out to another company. Cash flow from financing activities covers the activities that are related to raising or repaying capital. So that'll cover stuff like taking a loan from the bank, raising money from investors, or paying dividends to the owners of the company. Reading a cash flow statement can be kind of tricky, so we'll try to take a bit of a simple approach. One of the first things you'll want to look at is your cash flow from operating activities, as this tells you how much cash is being generated from the business's main activities. This ignores how your company was funded, it just looks at what the company does. And you want to make sure that what your company does generates cash. But if the income statement shows that your company is profitable, but your cash flow from operating activities looks a little too low or is negative, you'll have to dig in here to see what's going on. Maybe you're accumulating inventory that you can't sell, or you're making sales but you're not collecting cash from customers. The cash flow from operating activities will help you identify any issues in this regard. The cash flow from investing activities can be interesting as it identifies whether or not your company is making investments into the future. For example, if your cash balance goes down, but you see that in the investment activities section, that money was spent on buying a new warehouse, that might be a good thing because you're expanding. On the flip side, if you had a huge influx of cash because you sold a bunch of machinery, that might not be so great. In the cash flow from financing activities section, you'll be able to see if money is coming in or going out due to those financing activities. Money coming in could be a good thing because it means you're expanding, but it could also mean that you're borrowing money because you're experiencing cash shortfalls. Generally, it's good to see this number slowly paying off the debts that you have. The cash flow statement is a tricky one to analyze because positive or negative numbers are not always good or always bad. There's a lot more nuance to it based on the specific circumstances of your business. But it's an extremely important statement to understand because cash is really the most important thing in your business. If you want to learn about the cash flow statement in more depth, you can learn about it by watching the video in the corner or finding the link in the description box below. If you can read the income statement, the balance sheet, and the cash flow statement effectively, you can get a very good understanding of how your business is performing. And these three statements are very closely linked together. For example, the net income from your income statement is added directly to the equity of your balance sheet. It's also the beginning of the calculation from where your cash flow from operating activities is generated. To illustrate how they work together, we can look at a little example. Let's say I start the year with $300 of accounts receivable on my balance sheet. During the year, I earn $800 of revenue and send out $800 of invoices. So my accounts receivable goes from $300 to $1,100. During this time period, I also collect $500 of those receivables. So I end the year with $600 of receivables left. That means that over the course of the year, my accounts receivable balance increased by $300. So while my income statement shows that I should have received $800 in cash, I didn't actually receive it all. And that's something that I can see on my cash flow statement. And if I collected $500 of receivables, that means I also increased my cash balance by $500. So on my cash flow statement, I'll show that I had $800 of net income. However, I also had a $300 increase in my accounts receivable balance. That means that only $500 of cash went into the business. And that matches the $500 increase that I see on my balance sheet's cash account. It's a bit of an oversimplified example, but hopefully that gives you an idea of how the three statements work together. So to wrap up, the three financial statements are incredibly important to understand your company's financial performance, your financial position, and your cash flow. And by understanding and analyzing these three reports, you can get a much better understanding of how your company is doing and what you can do to improve things. So this was a beginner's guide on the three accounting reports. If you found it useful, why not like, share, and subscribe? But for now, thank you for watching and take care.